For the first time in its history, Belgium now taxes the gains on your investments. If you invest and you've never heard of this, you could get a tax bill that you weren't expecting. But here's the good news. For most long-term investors, it's a lot smaller than you'd think. And hopefully by the end of this video, you'll know exactly how to work it out, how much you owe. So I'm Thomas, I co-founded a fintech and also wrote a book on ETF investing in Belgium. So let's break down the capital gains. So what's actually changed? So for years, Belgium was almost a tax haven for investors. You paid taxes here and there, but there was no actual general tax on your capital gains. It was mad. So you could buy a global ETF, hold it for 20 years, sell it, and actually pay nothing on the growth. So that actually changed on the 1st of January 2026. There's now a general capital gains tax on what you make when you sell your investments. And it's pretty broad. It's not just stocks and ETFs. It's index funds, bonds, crypto, gold, options, the lot, everything. And both Belgian and foreign investments. So one thing that catches people out though is that accumulating ETFs are now included too. It used to be a clever way to avoid Belgian dividend tax, and they still are, but the gain when you sell is now taxable like anything else. So how much is it then? So the rate is 10% flat. That's 10% on the gain you realize when you sell. And that word realize actually matters. It's only triggered when you actually sell. So if you just hold, even if your portfolio doubles in size, single cent, the tax only shows up the moment you cash out at a gain. So a buy and hold investor who rarely sells barely interacts with this tax. A frequent trader interacts with it constantly. So it's the same rule, but obviously a very different outcome. And here's the part that kind of changes everything, and it's why most long-term investors are going to pay little or nothing. There's actually a yearly exemption of 10,000 euros per person. So you only pay the 10% on gains above 10,000 euros in a single year. If you're married or legally cohabiting, that's actually 20,000 euro combined. So let me put that into perspective. To even reach the exemption, you'd need to realize more than 10,000 euros of profit in 1 year. Most people investing a few hundred euros a month, holding for the long term, won't come close to it for years. And there's also a small carry forward. So what it essentially means is that every year you can roll up to 1,000 euros of your unused exemption, and that's capped at actually 5,000 euros over 5 years, which can push a single year's exemption up to 15,000 euros. It's nice to know. It's obviously not essential, but this is actually quite interesting to have this exemption. But you've already been investing for years, and this is the most important detail that you need to know if you're an existing investor. So any gain up to the 31st of December 2025 is tax-free. The clock starts at that date. The way it works is they take the value of your investments on the 31st of December 2025. That's your starting point. Only the growth after that date actually counts. So let me show you with an actual number. So let's say you've built up your IWDA position. It's worth, let's say, 50, for the sake of making this example super simple, 50,000 euros on the 31st of December 2025. You keep investing, and let's say that in 2027, you sell what is worth, let's say, around 62,000 euros. So what you want to do then is minus, obviously, the 50 from the 62, so that's 12,000 euros of gain. Then let's say you subtract your 10,000 euro exemption, which leaves you 2,000 euros, which is actually taxable. 10% of that is obviously 200 euros, and that's the tax that you have to pay. So you can see that's the reality for most long-term investors. It's not the scary headline numbers that you're going to pay 10%. There's also a rule until the end of 2030 that you can use your original purchase price instead of the 2025 value if that's actually higher. So that means if stocks went down, you're actually never worse off. So it's not that bad when you kind of realize it and break it down like that. So one quick thing, I put out one of these videos built specifically for Belgian investors every single week. So if you find it useful, please hit subscribe, leave a comment. It generally helps. All right, so let's get into it in terms of how we actually collect the tax. So how do you actually pay the tax? So a lot of it will depend on your broker. We built a guide that kind of looks at the whole capital gains. It goes a bit further than just this YouTube video. So I really suggest that you take a look. And if you go onto the table of contents on the left of the article, you can see how the tax is collected by brokers and platforms. And so what's really interesting with this is that there are so many different ways. Obviously, if you're with a Belgian broker, let's say Bolero by KBC or Me Direct, they will offer you the chance to withhold the 10% for you automatically when you sell. It's called a liberating withholding, meaning you don't have to declare anything. It's very convenient, but there's a catch, and there's always a catch. And so we actually look at it in the article, exactly the reasons why it's not so great. So the big problem is that it ignores your 10,000 euro exemption. It ignores any losses you made, and it applies to the snapshot value by default. So very often, and this is going to happen again and again, is that it takes too much, and then you actually have to claim the difference back on your tax return, which can take up to 2.5 years, which is crazy. So you can choose actually to opt out of the withholding and just declare it yourself. If you're with a foreign broker, let's say like DeGiro or Trade Republic, Interactive Brokers, there's going to be no withholding at all. It does it for you. It's entirely on you to calculate the gain and then actually declare it yourself. And there is a problem with declaring it yourself. Doing this, it can be painful. So you need first in, first out matching for what you sell. You need to do a weighted average for everything you held before 2026, and the snapshot value on the 31st of December 2025, your exemption, your losses. It's quite a lot. Built a free tool for you to help you kind of do it for you. You can go to the calculator, you pick your broker, so you can take any of these. For example, if you put DeGiro, we give you examples of how to actually export for all your transactions from DeGiro, add them into the website, and now it will work out and handle your tax automatically for you. Here, I'll show you actually how a report what looks like. This is just an example report. And so what you can see is that it works out your exact tax, handles all the hard parts, the first in, first out, the snapshot, the exemption. Obviously, there are step-by-step export guides that we're going to build out for more and more brokers, so you know where to get your files from. And of course, just play around with the tool and feel free to send any feedback on it too. So what should you actually do with all this information, and should you change strategy? So there are 3 things I'm going to highlight now. So 1, do not panic sell before some imaginary deadline. For most long-term investors, the exemption and the snapshot mean you owe little or nothing for years. Selling everything to get ahead of it usually just creates like a bigger tax bill that you didn't really need. 2, the 10,000 euro exemption is per person and it resets every single year. So if you ever do need to take profits, you can do it gradually and stay under the line. Thirdly, and the last one, this doesn't change the plan. Remember that if you keep buying your global ETFs, you keep it simple, you keep it going, the tax is just a detail at the end, not a reason to stop. And obviously, none of this is personal advice. If your situation's complicated, please talk to an accountant, they can help you. And so thank you for watching this video. The capital gains tax is just one of the taxes Belgian investors have to deal with. There's also the TOB, which is the stock transaction tax. There's the Reinders tax on bonds. There's a dividend tax as well. In an upcoming video, I'm actually going to break them all down so you know exactly what you're paying and when. If this made the capital gains tax make sense, please subscribe and I'll see you in the next video.